So you'll probably remember this diagram from the intro to the technical analysis lesson at the start of this module. And essentially, if you're not super comfortable and if you haven't spent the time testing those previous concepts on market structure, on supply and demand zones, then I would massively advise you to not really watch this section just yet. And the reason why is because liquidity concepts, I think they can just cause unnecessary confusion until you have mastered structure and supply and demand zones first and foremost. Now, I'm not saying that to try and insult your intelligence. It's just more because, I personally know how powerful just using both market structure and supply and demand concepts together on their own. I know how effective that can be and how much success that you can have keeping the strategy as simplified as possible. So when we're going to start to add liquidity concepts, it can help us to refine our edge just that much bit further, and it really brings the strategy up to another level, but it is not necessary to be consistently and highly profitable. Now, it may be a bit overwhelming if it's the first time learning this style or if you're just new to trading in general, and I just think you can end up limiting your speed of progression, which is just exactly what I do not want to happen for you. So this is why it's just really imperative that you really have that solid understanding in the core components of the strategy, which is market structure combined with S&D zones, and you've spent a fair amount of time testing and getting comfortable with those alone. Okay, so there's your little warning. I'm sure some of you are just blindly ignoring me, and that's cool. So I'll shut up now and let's just crack on with it, shall we? So liquidity is a concept that can just get unnecessarily overcomplicated. So we're going to keep it simple for our purposes in the market. So market liquidity is essentially the amount of demand and supply in a market. It is the ease to which a market can be traded without severely affecting its price. So this diagram illustrates what liquidity looks like in terms of an order book in the market. So each of these lines represents a price level in the market. If a market is very liquid, there will be bids and offers at every single price level, but also with a large amount of volume sitting there on each level. So if you have ever clicked, buy or sell with an at market order on, say, euro dollar via your FX broker, then it's very likely that you would have got instantly filled because it is an extremely liquid market, and there will pretty much always be enough liquidity on the other side of your order to instantly fill your trade, especially if you're just a retail trader and you're not putting through, billions of dollars at a time. However, with illiquid markets, there may not actually be any bids or offers at certain price levels, and or the quantity of supply and demand at those levels may be much lower. So a very typical example of an illiquid market would be the housing market. Everyone knows property. If you put your house up for sale, there will not instantly be someone just standing outside your front door, knocking on your door, ready to buy with the exact amount that you're asking for the house. They're just not just going to have that in a briefcase in cash, right? They're not going to be a willing buyer straight away for you to sell to. So that's a pretty good example of an illiquid market. It can take months at a time to make that transaction go through. But in the FX market, illiquid market conditions are pretty much where you're going to very often see price gapping, either up or down to fill the next best available order, wherever that may be. Because remember, for every buy order in the market to be filled, it must be matched with an equivalent sell order, and vice versa. For every sell order in the market to be filled, it must be matched with an equivalent buy order for a trade to occur. So if you were trading this illiquid market, let's just say you placed a market buy order of $700,000, you would instantly absorb all of the liquidity at the nearest ask price, and price would continue to shoot up another 5 price points until all of your demand had been absorbed by the market. So price is constantly seeking liquidity to rebalance price. So when we see those large imbalances between supply and demand in the market, when we've been looking at those zones on our price chart so far, that's what's happening, right? We're essentially just viewing this process on the order book via the price action, right? Via the candlesticks on our charts. So price is moved by that imbalance between supply and demand, and it keeps moving to seek liquidity to then rebalance price at a fair value. So the aim of the game that we are playing by using technical analysis is essentially using all of these concepts as a mechanical framework to read what is happening on the order book via the price action on our charts. So we use market structure to help us with direction. So whether price is bullish or bearish, if we are trading with or against the trend, how this all fits together within the multi-time frame story, and how well priced it is within the leg, right? So we were using premium and discount tool to help us with that. Then we have looked at how we can use supply and demand zones to show us where large orders have entered the market to cause those huge imbalances and shifts in price, and therefore where orders may potentially be left sitting in the market, so that we can then use that to our advantage when price returns to those zones. There is another tool and concept that we can use to help us identify where large pools of orders may be sitting in the market and where price may gravitate and move towards, and that is of course using liquidity concepts. Now, liquidity in the market essentially acts as a magnet for price to be attracted to, because after those huge shifts in supply and demand that have caused those big imbalances in the market, price is then constantly seeking these liquidity pools to tap into, to try to rebalance price, and then provide fuel for further market moves. So identifying liquidity in the market, can obviously be a very useful tool for us to use in our analysis. But if we are not looking directly at the order book, then how can we actually spot where there is liquidity lying in the market on our price charts? Well, there are three main types of structural liquidity in the market that we're going to be focusing on within our price charts. So if we look at swing structure, or even any sort of structure created in the market, once that market structure has actually been created, whether it's a swing high or a swing low, more than likely there will be orders that are sitting just below the swing low or just above the swing high. And those orders are going to exist for a multitude of different reasons. Anyone who has bought at the swing low, they are most likely going to have their stop loss just below the low. And anyone who has sold at the swing high will most likely have their stop loss above the high. If we are looking at people who trade breakouts, they would have their sell stop order just below the swing low, right? So if they were looking for price to take out that swing low, and if they wanted price to keep going down, then they would have their sell stop order just below that swing low, right? And they'd be looking to get taken into that bearish move. And of course, the opposite is true, as breakout traders would also place a buy stop order just above the swing high, right? If they wanted to get taken into price breaking that high to the upside. Now, of course, there will also be orders just resting there behind those structural swing points, simply because price previously reversed and turned away from that swing point without actually tapping into those orders that were always there just behind where that swing point has now formed. So that's how there's multiple reasons for why we know there will be resting liquidity pretty much behind every structural swing point in the market, and price may eventually seek the liquidity behind those structural points in order to rebalance price whenever there are imbalances between supply and demand. So when you also have relatively equal highs or lows, they do not have to be perfectly equal, but when you get this, such as a double top or a triple top, for example, there will be loads of orders sitting behind them for the exact same reasons that we just listed. So traders will have stop loss orders behind them, as well as traders looking to play a potential breakout of those levels. And the same goes for the trend line, as people are buying an ascending trend line. So orders, those pools of liquidity, they will starting to be building up below the trend line. And then when people are selling a descending trend line, liquidity of course will be building up above that trend line. Then eventually an overwhelming amount of supply or demand will eventually step into the market, causing an imbalance in price. And then this is where price will then move to seek out those liquidity pools, to tap into those resting orders in the market to then rebalance price. So what you can do is you can think of those dotted orange lines drawn on here on these diagrams. You can think of those as kind of like magnets in the market. They are all areas on your price charts where price will be gravitated towards to tap into those orders, to tap into that sitting liquidity for price to then fill and rebalance itself. So those are the three main types of sort of ways that we identify liquidity on our charts. But of course, they also come in slight different variations like this, where we don't have perfectly equal highs or lows, but what you can call more of a momentum shift, where liquidity will still be building behind them. Or we can have a range forming, where liquidity will be forming up on either side of the range. But again, those are both just based on the concept of relatively equal levels in the market. So now we understand what liquidity is in the market. We've seen where we can identify where it is sitting in the market, and why price will be magnetized towards it to seek those pools of liquidity to rebalance price. So now the question is, well, how do we actually utilize these liquidity concepts for us to capitalize on and make profitable trading decisions? Well, there are two main ways in which we utilize liquidity within our trading. The first is a concept called inducement, and the second method is to use liquidity to identify sweep zones. So let's take a look at the first method, which is using liquidity for inducement. So inducement is really just a fancy word that has been bounding around the trading space in recent times, and essentially all it means is to induce or to lead other traders to take the other side of your trade. So remember, for every buy order, there must be an equivalent sell order, and for every sell order, there must be an equivalent buy order. So if you're a large institution who needs to put a huge order through the market, you're obviously going to want to do this where there will be a large amount of volume, so a large amount of liquidity to take the other side of your trade. Because otherwise, you're very likely going to experience really bad slippage, and you will get filled at an unfavorable price level. So let's take a look at some examples to explain how this theory can work in the market. So one of the very common patterns that occurs in the market is relatively equal highs or lows. In this case, many traders would call this double top, but of course you can have triple or quadruple tops and so on. But the point is that it's a pretty obvious level in the market, right? So traders would see that price has failed twice to break up higher above that level, so they may see this as a strong resistance level. And so they would sell and get short because they hope that price will sell off from there and not break higher. Now, other traders would see those equal highs in the market, but they may be bullish overall, and they might think that if price can actually break up through that strong resistance level, right? So if price can get above that double top, then they think that price is going to go to the moon, and they want to get in long on the breakout. As these equal highs can also look like a very common price pattern that is often referred to as a bull flag that some of you may be aware of. And then finally, you may have some traders that are also bullish, but they want a little bit more confirmation on the breakout. So they wait for the break and retest of that level, right, of those equal highs for them to then buy out. So that's just three simple but different scenarios of how many traders could all be looking at the same double top, the same equal highs in the market, but looking to trade it in a different way. However, all of these different scenarios all have one major thing in common. All three of these scenarios lead to those traders placing buy orders right above those highs in the market. So in the first case, if you are short from that double top, you will most likely place your stop loss order somewhere up above behind those equal highs, right? And remember, if you are short and you have sold, then if you get stopped out, you need to buy back your position. So that means that your stop loss order is actually a buy stop order. In the second example, if you were looking to get triggered in on the breakout to get long, you will also have a buy stop order somewhere above those equal highs. And in the final example, if you were looking to buy the break and retest of those equal highs, then you would set a buy limit order somewhere above those equal highs, right, for price to tag you in. So what does this information actually tell us? Well, using that knowledge that there is likely a ton of buy side liquidity sitting right around that price level above those equal highs, in theory, this could likely be an area that big money is going to want to step in and sell at, because there are enough buyers for them to sell to without experiencing terrible slippage. Because remember again, for every buy order, there must be a sell order, so they need to find buyers to actually sell to. So at these very obvious points in the market, right, when everyone can see these levels, where you can see where there will very likely be a ton of buy-side liquidity building up, then that is a way that we can essentially view the order book, but on our price charts instead. And we can start to piece this together with other confluences that we use to realize that potentially big money will be entering the market in those areas to sell against that buy side liquidity. Okay. So because there will be many instances where traders get short from a double top and they be running, in a little bit of profit before price then pulls back, just stops them out of their position before price then reverses back in their desired direction and moves without them. Or when breakout traders get long, right, when those equal highs, that level breaks and price is moving in their favor for a little bit, but then it suddenly just rapidly reverses against them and stops them out. Both of these types of traders are probably then extremely frustrated, angry, pissed off, and probably confused as to why this has then happened. And you'll often hear people refer to this as a stop hunt and complain that they were manipulated by the market or whatever. But a lot of the times, the reason why is because those obvious structural levels in the market, they formed just in front of a key area where big money is about to step in and take the other side of their trade. So imagine if we have identified a very strong supply zone, right, this grey box here, and then when you see liquidity forming just in front of that zone, whether it be a swing point, relatively equal highs, or a trend line, either way, whenever you can see that there will be a pool of liquidity, a collection of buy orders just below a key supply zone, you will find that it increases the probability of these zones actually playing out. Now, the theory, the whole school of thought behind this is that these patterns in the market are essentially formed, engineered, or created for the sole purpose of inducing buyers or sellers into the market, right? In order to create liquidity for large players to then buy or sell into. Now, I personally have no idea, or I have zero proof whether or not that is actually the case. But to be honest, I don't really care. And the reason why is because what I care most about is whether or not the actual concept, works in reality. So what I've found is with my experience in the market and the extensive testing and data collection that I've done on this, is that when you actually see such an example in the market, where you see liquidity building in front of a supply or demand zone, this does tend to increase the probability and the strike rate of these zones playing out in the desired direction. So kind of having, inducement and liquidity like this in front of a zone, it's not necessarily a strict requirement. It may be in your plan, it may not be in some of your plans, right? You'll figure this out with time, how you like to trade, what works for you and what doesn't. But in general, they do definitely increase the strike rate overall. So that's a brief overview of the theory behind using liquidity for inducement in the market. Now we're going to take a look at the second method that we use to utilize liquidity concepts with our actual trading, which is something called sweep zones. Sweep zones are essentially just another way that we can, refine our supply and demand zones in the market. So of course we have, the two main methods for being a strict requirement for validating what a strong zone is. So can you remember what those are? That a zone either needs to break market structure or it needs to take out another zone, right? So we have structural zones and we have flip zones. And those are the two main methods for validating strong zones. And they should kind of be a minimum requirement, in my opinion, for looking to build a trade idea around a supply zone or demand zone, right? Or looking to trade directly off it. So it needs to either have broken structure or it needs to have taken out another zone, right? A flip zone. So these sweep zones here, they are still based on structural and flip zones, but it's just an extra piece of confluence that we can look for in those zones when they are created to increase their probability and strike rate even more of giving us that large, but also that sustained price movement that we want to see when price reaches these zones and we look to trade from them. Okay, so again, we're still looking for zones to either break structure or take out another zone, right? They're the two main ways, flip zones or structural zones. But this is just another thing that we can look for when those types of zones are created, is essentially whether or not they took liquidity. So, if you were to try and define a sweep zone, very simply, it's just a zone that takes liquidity when it is created. So essentially price will sweep structure and then reverse the other way, then breaking down through structure or, taking out another zone to then create a strong supply or demand zone. So when you see this manipulation occur in the market, when a zone is created, these are often very high probability zones when of course you combine this with all of the other analytical concepts that we have looked at so far. So if we now combine, both of those liquidity concepts together, both a sweep zone and inducement, this example here is a very typical setup that we will very often see in the market. So price is trending to the upside, right? It then starts to build liquidity. In this case, buy side liquidity is building up above those kind of relatively equal highs. So there is a lot of buy orders building up just in front of that higher time frame supply zone. Price then sweeps those highs, taps into the supply zone, where then the big money is then triggered into the market, utilizing that buy side liquidity to take the other side of their sell position. However, the imbalance between supply and demand is still big enough to cause price to break structure to the downside and take out demand to the downside, right? Creating another supply zone, that blue zone there, which in this case is now a sweep zone. It's a sweep zone because it took out and swept liquidity behind those equal highs as it was created. So now as price starts to pull back to the newly created sweep zone, that blue zone, it pulls back nice and correctively, and it starts to react and sell off from the previous minor supply zone. Now that minor supply zone, I haven't drawn it on in this case, but you can see how there would be one, right, from that minor pullback in that bearish swing leg, but it doesn't have any inducement in that leg. So what happens is price only has a short-term reaction. it fails to break the low. And as this price action is occurring, tons of liquidity is now building up on both sides of that range, right? Below the equal lows and above the equal highs. So then when price breaks up, it sweeps the buy side liquidity that was being induced above those highs, right? For then the large money from that supply zone to then sell into, right? As that zone is tapped into, and the big money then steps in, and price then rapidly moves down as it seeks more liquidity to rebalance price, and it targets the sell side liquidity below those equal lows. So here is another common example of sweep zones and inducement concepts when we combine them in the market, and in this case when price is trending. So on the left hand side, right, where we have this bearish structure, you'll see how price pulls back to form a lower high. But in doing so, right, on that first pullback, a sweep zone is created because the internal structural high is swept before the real move starts to break structure to the downside to form that lower low. So again, if you look at that first initial swing pullback here, that's in the orange circle, you see how price pulls back, then it forms an internal lower low. Right, so many traders would then be short or looking to get short because they may think that the swing lower high is now in place and price is ready to form that swing lower low, right? They think it's ready to start to break structure to the downside. However, in this case, price then pulls back up and it sweeps that internal high to then form another higher high, tapping into that buy side liquidity that had just been built up between that previous internal high. But then the big money steps in, using the other side of that liquidity, right, to then actually cause price to sell off and actually break that swing structure to the downside this time to then create a strong sweep zone. Then after we have that new lower low, price then pulls back correctively, forming more buy side liquidity, inducing buyers into the market just in front of that new sweep supply zone, right, again for the big money to then sell into that buy side liquidity. And the exact same thing occurs in a bullish market on the right hand side, right, where we have sell side liquidity building in front of those demand zones. Now, another common example is where you will get a series of mitigations, right, as bullish order flow is holding, with demand being respected each time. So price pulls back to those demand, breaks up higher, pulls back to demand, breaks up higher, right? But anyone who is essentially still long in the market when this is happening, they will likely have their stop losses below that trend line that is now forming. Right, and there will also be plenty of breakout traders who will be looking to get short on the bearish breakout of that trend line. So then when price reaches a really strong supply zone, that then causes an overwhelming imbalance between supply and demand. Price will then start to sell off aggressively to the downside, and there will be almost no demand in its way to stop price because most of those previous demand zones have already been mitigated. Right, the orders have already been filled, which essentially has cleared out those demand zones. So, when price then rapidly moves to the downside, it can then move pretty freely to then move down and sweep all of that sell side liquidity sitting below that trend line to then rebalance price. Now, this is an extremely simple but very, very important point, and that is structure is far more important than liquidity. Liquidity is generated all of the time. We will never know when it will or won't be used. But we can assume, however, that if the market is trending, then we just assume it will continue to do that. So in this case, if the market is clearly bullish and price pulls back up to a supply zone, if there are equal highs just behind that supply zone, obviously that is not ideal because price could of course want to sweep those highs and utilize the liquidity pool that is then sitting behind those highs. However, if price is bearish and that is the swing high, then we can assume that that swing high is strong and it will be protected and price will not trade higher. Because if you are always anticipating and you're just waiting for liquidity to be swept first, then this can mean that you will very often end up missing trading opportunities. Now, this is something that will be different for every trader, in terms of whether you are happy to trade and get short from a supply level like this, when it has an obvious liquidity pool behind it. But like everything, it will come with time and experience in how you wish to approach these situations. So my advice is to always react to liquidity sweeps and do not necessarily predict that price will or has to sweep it first before price may move in your desired direction. So what does this actually mean in reality? Well, let's say your entry model sets up in the supply zone and you get short, but then price ends up pushing higher and actually sweeping those equal highs behind the supply zone, stopping you out of your position. That's okay. It's just part of the game and the risk that you will need to accept before you enter and take that trade. If you, of course, you are happy to trade from that level, right? But then what can happen is price can then sweep those highs and it can retrace back inside the swing range without the candle actually closing above the swing high. So what this means is there was no true break of structure, right? If you're using type 1 mapping, it was just a grab of liquidity. And when this happens, this is a very high probability setup for price to now commence that next bearish leg, because it's grabbed that liquidity to fuel the next move to the downside. So then again, you can look for your entry models to get short. So in this case, you were initially aware of those equal highs. You knew there was a possibility that price could sweep it before the real bearish move started, but you were happy to take that first short when price first reached the supply zone, accepting the risk that you could be swept out. But then when the sweep does happen, you then react to this and then you then take the next valid setup that presents, okay? Now, you may remember this example on the daily chart on Euro-Dollar that we've been looking at in all of the previous lessons, whereby the daily had started that new bearish trend. Price pulled back up towards the swing high, right, for quite a number of days. Price was then chopping around just below that swing high, which then led to tons of buy-side liquidity building up above that swing high. Price then eventually tried to break out to the upside, but it was just a sweep and grab of all of that liquidity that had been building up, as big money then stepped in that same day and smashed price back down so that the daily candle then closed back below inside that bearish swing range. So this means that there was no true break of structure to the upside, right? It was just a wick break. And that's why I prefer to use type 1 mapping for true breaks of structure. I want to see the candle closure because that means now that you can understand what's going on, when you just get a wick break, that very often it can just be a grab of liquidity. Of course, not always, but a lot of the times it can be. Now remember, we always want to trade away from sweeps. So when price, in this case, when it's swept to the upside, we then want to trade away from that. So we want to trade the following bearish move. So then when price then, continues that bearish move, right, continues downside from here, and it breaks structure to the downside to form that swing lower low, there will of course have been liquidity sitting below the previous swing low to the left, so that when price then comes down and it sweeps that liquidity sitting below the prior swing low, price will then sweep that and it will start to pull back to then form the next lower high. So that's why we always say, what happens after a break of structure? We expect a pullback. Why? Well, because price has swept liquidity from the prior swing structure, so now we want to trade away from that. And that's why we can then trade that counter trend pullback, okay? So there is literally liquidity behind every single structural swing point in the market. And that's why every time any piece of structure is broken, generally you will see some form of reaction, whether it's a full reversal or, just a pullback. Now, one kind of other thing to consider when looking at trading from a particular zone is the nature of price action as it is pulling back to the zone. So always ask yourself, how is price being delivered? If price is pulling back slowly and correctively, then you can see in kind of both of those first two examples how liquidity is being built up as inducement for price to sweep into the zone, but then also for liquidity to target for price to then go on to take after the zone has been mitigated. So these are the types of pullbacks that you generally want to see when price is returning to the zone that you're looking at. However, in that final third example, if you see a V-shaped return, where after a large impulse in price, where that sort of zone was created, if price then has a sharp, almost vertical retrace straight back to the zone, not always, but a lot of the time, this is not a good sign because there is no inducement. And a lot of the time, price will then just disrespect the zone and eventually break down and sweep past it. Where essentially where that zone was created, that ends up being inducement for a zone, below or above it. Now this concept for price delivery, back to the zone, it's not super important, but it's just an extra piece of confluence which can, potentially help to boost your strike rate. So I personally wouldn't massively worry about this too much at all, especially when you're first starting out, but it is something to bear in mind as you start to progress and you're just looking for those, extra refinements that you can potentially make. Right, okay, that pretty much wraps up the theory. So what we're going to do is we're going to hop on the charts just to look at kind of one last thing, our infamous price action example that we've been building on pretty much every single lesson so far. So yes, this is your 5-second warning to reduce your screen brightness if you are sitting in a dark room, because we are of course about to potentially blind your retinas with my white charts. Alright, so we should be pretty familiar with this diagram by now. And all we are simply doing is just applying the liquidity concepts that we have just gone over All right, in this theoretical lesson, I'm kind of just looking at a bit more of a clear-cut trading example before we're going to hop on the charts in the next lesson or two. So, starting off at the start of the diagram, what do we have? We have this thick grey line as the 4-hour chart. Price moves up, it pulls into a previous supply zone. What do we know about previous supply zones when we are in a bullish trend? Generally, they will facilitate a pullback, right? Of course, we could go on to reverse, but generally old supply zones are there to then produce and facilitate that pullback. Now, in this case, in this example, price pulls back, right, with this internal structure, right? So imagine and then price is pulling back, it forms an internal lower high. It then takes that low, right, continuing that bearish internal trend, and then price takes that high. So we get that change of character, right, that first initial minor breaker structure to the upside, creating a higher high. So then that means that there will be a decent amount of liquidity below this low, right, for traders who are looking to potentially get long, or for traders who are looking to sell the breakout of that, what should be, a reasonably strong internal low. And then what can end up happening, of course, is if price then sweeps that liquidity, right, and then that fuels the move to the upside, then that will create us a pretty decent sweep zone, of course, when price then goes on to break structure. So we build some more equal lows here before price actually goes to break structure, a bit more of a minor pullback there, and then again another minor pullback, building liquidity above that high as price then sweeps a high, moving into that supply zone, that 4-hour supply zone, right, to then facilitate that next pullback there. Then if we jump down to the M15, right, and we can start to look to play that 4-hour pullback. What do we have? We have that pullback into demand. Price then pulls back up. Again, the exact same thing, right? We get an internal lower high. Price then sweeps that high. And then we get that failed reaction and that change of character, that breaker structure to the downside. And then again, build some not minor, but with that minor high, we have a build of liquidity behind that high. And even on the pullback as well. And all of this acts as inducement for what? Inducement for this supply zone, which is a sweep zone because it took liquidity when it was created and broke demand and structure to the downside. There's then inducement in the leg, right? So it builds up that buy side liquidity for, in theory, that big money to then sell into and continue that pullback down here. Now, as we're pulling back, what can end up happening is we can start to sweep all of that prior liquidity that was built on the way up, okay? So all of this is internal range liquidity. Any sort of liquidity that is, within the swing high and the swing low is essentially classified as internal range liquidity. And then any liquidity behind those swing highs and swing lows is essentially, external range. So internal range is everything between the high and the low. External is obviously basically behind the high and the low. So after we get that break of structure, generally that will be a sweep of liquidity and eventually we'll get a pullback. So in this case, in this diagram, it's obviously a very exaggerated movement after we get that break of structure. Obviously there's going to be tons of liquidity sitting externally, and then eventually that facilitates that pullback. So then later on, when we get that break of structure over here, right, we're again tapping into the external range liquidity that has been building up the entire time price has been pulling back, right? There's going to be loads of liquidity building all up above the top of this range, right, atop of the 4-hour swing high. So then eventually when price breaks that high, we don't know when, it could literally be a pip, and you will see this, even a micro pip, it breaks, and then it can facilitate the pullback, right? So literally the minute that line is broken, that is essentially that external range liquidity being tapped into, that's built up here that entire time, and then that starts to provide that liquidity sweep for price to pull back, or of course potentially reverse. So yeah, it's kind of just the difference between internal range and external range liquidity. It doesn't really make a massive difference in terms of how you define it. It's just kind of just so you understand what's going on. So generally, when you are looking at this M15 price action, every time we get that reaction to pull back for a lower high, generally we'll be doing one of two things, if not both. It will either be reacting to a prior demand zone, right, in this leg here, to facilitate that pullback, or it will be, imagine there was a minor low there or a 15-minute low, right, just like this low here, it will most likely be sweeping that low, and then that will also facilitate the pullback, okay? So you'll either get the demand zone, in fact, let me just draw it on so you can see exactly what I'm talking about. So we'd either have, say, an M15 demand zone, for example, right, and also if you imagine that demand zone would have been created from a minor leg, right, or it may have a more accurate one would be a bit of inducement in it. So then as price comes down, it sweeps that low there, it taps into demand, and that will facilitate the pullback. So Again, when we come down and we sweep this minor low, it facilitates the pullback to kick in, and the exact same thing. So as we come down into this 4-hour sweep zone, right, remember it took liquidity and then led to the break of structure and the failed reaction. So it's a sweep zone, a structural zone, and a flip zone, right? This is kind of our highest probability zone, and it's at the origin of the swing move. So this is where that strong swing low should be holding, right? This is, as good as it gets essentially in trying to catch that higher low and that pro trend move. We then induce sellers into the market, right? So anyone who's kind of getting long from this double bottom already, right? If we draw on this, right? Imagine, oops, just move this up out of the way. Get nice and small, there we go. So anyone who's, say, essentially long from the double bottom, right? Likely to have their stop anywhere below these lows, right? Obviously, some people can have wider stops. It's not just going to be, one deadline below it. There's just going to be a ton of orders all within kind of this whole range, right? Or the opposite of that, there are going to be people who see those strong lows and they're going to think, okay, if those strong lows go, I'm going to want to get short, and they will put their sell stop order on the break of it, right? So there's loads of sell orders in that area, which in theory should then induce sellers into the market for this large demand to then buy against those sell orders, buy into those sell orders, right? For every buy order, there must be an equivalent sell order. So the theory is the big money that's stepping in here in the strong demand zone is going to then use that liquidity again to trade against. But eventually, there's going to be that overwhelming imbalance between supply and demand, where demand now is starting to take control. As we start to break these minor breaks of structure to the upside, we tap into demand, we pull back. That the supply fails to do its job, right? Because it fails to take out the low. Demand then steps in again. It causes the reaction to fail, and then eventually we get the change of character, creating our flip zone. Potentially there may be a very minor pullback on the way up, which just then again just acts as inducement, for the same thing happening, right? And then we pull back. Potentially we have this trend line holding, right? People look to get long here on the third bounce, but it just breaks down through, sweeps that trend line liquidity, sweeps that minor low there, and then again we get the same entry model, right? Failed reaction, so flip, chock, pull back in, and then we can start to target that weak 4-hour high, right? And that whole time, right, all of these moves here, all of this pullback is going to generally be creating, some sort of trendline liquidity, right? As people are starting to sell behind all of these lower highs, there's just going to be tons of orders all building up in this area, right? This whole empty bit of price action, where there isn't, price hasn't moved into yet, it's just going to be full of orders. All of this white space is just full of orders. Some people refer to this as a liquidity void, right? And eventually what's going to happen is price is going to move back up. So this movement here is essentially then filling all of the orders within the space that had built up, right? And now price comes up and it taps into all of that supply. But obviously demand is still powerful at this point, overpowering it. And then we eventually get up. We sweep that external range liquidity, right? That had been building up above this 4-hour swing range the entire time, right? Anyone who's trading this range, a lot of people still have stop losses above the highs, or people looking to break out on this level. So there's tons of liquidity up here. Price will then eventually sweep that and then facilitate that pullback, right? Using prior liquidity, on the way down. So remember all of this price action here where we got our entry model, and we see these series of mitigations with all of these lower time frame demand zones. What is that doing? Well, what would that look like if we just looked at candles? It would look like a bit of an ascending trend line. But what that is kind of in reality is tons of liquidity building up beneath those demand zones, right? As people are getting long and whatnot, right? Tons of orders are building within here. So when price comes down into our extreme demand zone, right? Because essentially this would be the origin of the move that actually led to that break of structure. So this would actually become, our new swing low at that point, right? And then we'd have our new swing high. And then obviously price could, reject any demand zones from along here. But obviously in this example, we've just drawn it with price coming all the way down to the extreme. It sweeps all of the liquidity that had built below these zones here, taps into our, origin of the move. And then in theory, we can then try and get another higher high. And this would become our next higher low. So yeah, hopefully that's starting to make a little bit more sense of how we use these liquidity concepts within our trading, because like I said at the start, right, liquidity is literally everywhere. It can also be quite subjective in terms of if you start kind of using these lines, right, to draw where you think liquidity is all over your chart, you'll be drawing all day. It will never end, right? Because it's everywhere, right? It's behind every single structural point in the market. But more what we try and kind of use this for is we try and be, using it in very kind of refined scenarios. And those two scenarios are, one, for identifying if a zone is a sweep zone or not. And two, just looking for, is there some inducement quite near our zone, right in front of the zone. Really, that's kind of what we're most interested in. You don't need to kind of go around and draw on all of this trendline liquidity. Of course, when you're practicing and you're just trying to get a feel for looking at how price sweeps it and then it reverses, it's good to do that. But in reality, when you're actually trading in the live markets, you do want to try and keep your charts as kind of clear as possible, just so you can really be focusing on the price action that is occurring. So one, right, we see liquidity get taken as it creates a zone that then, you know, increases the probability of this zone even more. Two, we then have inducement in front of it. Okay, so even in this case, what you'll often see is, you know, there will be minor demand here, right? Because, you know, this is where some demand stepped in, pivot created demand to lead to that break of structure. So then when price comes back to it, you know, we could have formed a high low here, but more often than not, you'll just see a bit of a small reaction as that demand is then filled. And then what's that doing? It's creating equal lows here. These equal lows still haven't been swept, but then it's also just creating that larger kind of, you know, bigger double bottom, right? It'll be more of that kind of classic horizontal support level that's holding, and then eventually that goes right, and then we're off. So it's just happening fractally all over the market. But what's more important is everything that came before the liquidity modules, right? Getting your market structure right first, knowing where your true swing highs and swing lows are, knowing what direction you want to be trading in, then identifying your supply and demand zones, either via a break of structure or via a flip zone, or ideally both, right? And then we can just increase the probability of either of those two types of zones even more by just seeing if they took liquidity when they were created, and or if they have liquidity just in front of it to induce, right, sellers if we were buying from demand, or induced buyers if we're going to sell into them from supply, right? And that's essentially it. You know, that's kind of as simple as I can try to explain it, and kind of as simple as I personally believe you should try and keep it in your trading, right? So yeah, you know, if you're not consistent or comfortable with just market structure and supply and demand on its own, I definitely would kind of, you know, advise you kind of don't worry too much about liquidity just now, and just focus on those two concepts, because you really do not need liquidity. It's just kind of just, yeah, you know, I've ranted about this enough before, but just to kind of give you that little extra fine tuning to your trading. So yeah, that's pretty much it. The only other thing I guess I want to add is just remember, whenever we get a sweep of liquidity, generally we will get a pullback. So that's what I mean. You know, when you're looking at internal structure, you see a prior high, that's when price will break. It taps into, you know, the liquidity that was behind that high, and that's when we get the pullback, right? Same thing, liquidity behind this high, we pull back. That then leaves a double top. We then build equal highs there, right? Price on the M1 would sweep that, it would pull back, and obviously then hopefully continue. So yeah, just kind of bear that in mind now when in the later lessons we start to think about management of how you can use this concept. You know, if you're in a trade, yes, we do want to target that. You know, if we've got long here, we do want to target, right? We're long down here. Ideally, right, this 4-hour week swing high to get that higher high, but not every time we get into the trade is it going to do that straight away, right? It could come down lower, it could mess around again and go off. So what we can do in that meantime, let's say we're running, you know, really decent profits, and we see some nice equal highs over here, right? Which is kind of poorly draw a dollar sign there. You may, you know, use that to your knowledge that when price pulls past that, when it sweeps it, it's likely to have a steep pullback, and maybe you want to pay yourself, right? So you can take some partial profits off the table, pay yourself just in case price then does come down, sweeps all of this liquidity, taps into another demand zone, and then we get the real move. Okay, so yeah, again, we can talk about management in a lot more depth later, but I just kind of want you to start, you know, thinking about the reasons why, you know, how we can use those concepts into our trading in as many ways as possible. So I'll leave that there. In the next few lessons, we're now going to go and just do, yeah, a real nice slow walkthrough on the charts, and just start to kind of put all these pieces of the puzzle together, putting everything we've kind of learned together now with just that final little tweak with liquidity, yeah, and just look at as many trade examples as possible. So watch this over as many times as you need to. Make sure you take plenty of notes. As always, try and draw these diagrams yourself, and it will really help to kind of fill in any gaps in your knowledge that may be there that you weren't quite aware of. So yeah, hope you guys took some value from that, and I will see you in the next one.